Thank you for joining us. I'm Richa, the moderator for today's webinar. I'm a financial sector manager on the company network team here at Ceres and mostly work with our member banks. As many of you would know, Ceres is a sustainability nonprofit. We work to transform the practices and policies that govern the US and the global capital markets in order to reduce the worst financial impacts of climate change and other sustainability threats. We are super excited to have you all join us today for the webinar following our release of a new first of its kind report on derivatives and bank climate risks. Many of you prior to the webinar, we were able to solicit questions from you, the audience. So thank you so much for those who enthusiastically responded to that. And today our experts and who are also the authors of the report will answer those. But please feel free to send us more of your questions that might come in through during the session. So please use the Slido tool. You can scan this QR code which is up on the screen. And also the link has been dropped in the chat. So feel free to please drop in any of the questions. And if you're not able to access Slido, please feel free to mail us those questions and we will try to get to you post the session as well. If you're using the Slido chat, please do mention your name so that we know who to respond back to. And with that, I am very happy to introduce two of our very distinguished panel members today and my colleagues, it's a pleasure to work with both of them. So Blair Bateson, who is a director on our company network. Blair leads work with our 13-member banks and has authored all of the Ceres banking reports. He's been with Ceres for almost 5 years and has a background in energy economics, investor relations, and investment banking. And Jim Scott, who is a senior advisor for financial institutions on our Ceres Accelerator. Jim is an expert advisor for financial institutions and regulators on climate risk management policies and best practices. He has extensive experience in banking and capital markets and has addressed audiences worldwide on topics at the intersection of finance and sustainability. So good morning, gentlemen. Really excited to be doing this with both of you. And we'll do the first round as a rapid fire question round to get some fun and also to get on speed with a few of the important elements of the report. So how this will work is I will ask the question and Jim and Blair would pose their response using a whiteboard on the screen, and then I'll invite both of you to provide a reasoning for your answers. So let's get started. So my first question to two of you is, how big is the derivatives market? All right, we have answers coming in. Oh, that's a significant difference. Jim, do you want to go first and explain us why?
Absolutely, absolutely. How big is the derivatives market? $200 trillion. I see Blair's got 600. I think we're both right, as my answer is the size of the U.S. market for derivatives. And fun fact: the top 5 U.S. banks control about 95% of this market.
And for me, I've got the global number here. The global value of the derivatives market is 600 trillion. So about a third of the total is in the US, but there is significant amounts around the world in Europe and other places.
Thank you both, Jim and Blair. That was super helpful. Moving on to my next question here. So by how much could banks' finance emissions increase if derivatives are included in the calculations of carbon accounting? Blair says 50%. Jim says 3x. Again, a huge difference. Blair, do you want to go first in explaining why?
Sure, yeah. So, as with all of our banking analyses, this is a little bit high level and illustrative, but what we did is we compared the derivatives mark-to-market credit risk reported to the OCC with, the total amount of syndicated loans banks have outstanding. And what we found is that the credit risk from derivatives is about 50% overall for the 25 largest US banks of the total syndicated loan market. So you're basically adding another half of your loan portfolio for the average bank. And I think that's where Jim's going with his answer is I went with the average bank of those top 25 US banks. I think Jim maybe went with the top banks.
I went for the biggest and baddest. I went for the top. So a bank's financed emissions could increase by a whopping 3 times. And again, I think we're probably both showing numbers that make sense. 3 times is the maximum in financed emissions for one of the banks that we measured. Overall, for all banks, it's an extra $1 trillion on top of their loan financed emission exposure.
Super helpful to note. Thank you so much. Moving on to our next question. There are a lot of different types of derivatives out there. So what derivative class should banks focus on first? Right. Blair says interest rate swaps, and Jim says physical oil and gas. Jim, do you want to go first?
Absolutely. There's obviously a ton of different derivative asset classes out there, but if I had to pick just one, I would have to start with physical settled oil and gas commodity derivatives. Why? Because these are derivatives where the contract settlement involves the delivery of the actual energy commodity. So the actual delivery of oil or the delivery of gas, for example. Now, although this business is not as widespread as other contract types, I think given that it's actually being delivering the hydrocarbons, I think its implication for real economy GHG emissions are pretty clear.
Definitely agree, Jim. It's a very critical asset type, but interest rate swaps are 70% of the market. So it's going to be tough to think about derivatives without thinking about interest rate swaps. Just the notional principle, it's so big and it just dominates everything that banks do in this space. So even though it's not necessarily directly connected to physical delivery of commodities, I would go with the interest rate swaps as the most important piece.
All right. Thank you for both of you for your perspectives on that. And just the last question for this round. I was wondering if banks wanted to incorporate climate risks in their credit valuation assessment or CVA models, how much would that cost today? All right. Jim says only 7.3 billion. Both of you have similar answers. But Jim has more to his point. So, Jim, do you want to go first and explain why?
Absolutely. I'm glad we agree, Blair, on at least one of these answers. So yes, it would only cost 7.3 billion this is for all the US banks combined. So although this is obviously a lot to you and me and everyone else on the webinar today, relative to the downside risk, which as a proxy, we're using the estimated $178 trillion cost of climate inaction over the next 50 years, the 7.3 billion is really a drop in the bucket on a relative basis.
And one thing I'd add to that, Jim, the 7.3 billion stacks up against over 7 trillion of sustainable finance commitments that the largest US banks have made over the last 10 years. And one thing we heard at our recent banking event that I thought was worth bringing up today is that, the transition has to be just, has to be done in a way that's not going to create energy scarcity and energy poverty, especially for people in developing countries, which means that the sustainable finance has to lead the reduction of fossil fuels. We have to have something to replace oil and gas with before we can draw down oil and gas. And so when we think about over 7 trillion of sustainable finance commitments, following that on with some measure of risk for the other side of things that is going to draw down as the renewables draw up seems only logical.
Agreed.
Thank you, Jim and Blair. That was really informative and fun. So now we want to move into some of the questions that the audience asked us, and we pre-populated that in our virtual mailbag. So I'll start with our first pre-submitted question here. And it asked, the question concerns the impacts of derivatives on the real economy GHG emissions. essentially this bank asked us why you wrote this report. As their view is that bank lending impacts the real economy, but derivatives do not because they're not financing. Blair, let me start with your thoughts on this.
Yeah, sure. So sometimes derivatives aren't financing. Sometimes they actually are. Some derivatives are structured in such a way to basically be a synthetic form of financing where, they are providing, short-term cash to the company and that's paid back later on. So there is part of it that is literally financing. But when you think about the pieces that aren't as directly financing fossil fuel, oil and gas projects or renewable projects for that matter, what you really have to think about is how this is impacting go or no-go decisions on these projects. And I used to work in oil and gas. My job was actually building the economic models for some of these projects. And, it's really obvious to me how derivatives do in fact impact the real economy in terms of whether or not fossil fuel projects are built, whether or not renewable projects are built. And I can go into a little bit of detail here because I think it's pretty important. When you're thinking about whether to build a new project in the energy space, particularly one that's going to last for years or even decades, you think about two things. You think about your sort of expected value or your NPV, how that compares to your cost of capital. And then you also think about the downside risk. So what happens if my assumptions aren't correct? What happens if oil price is different than what I think? What happens if interest rates are different than what I think? And so the way that we account for that in models is by running like a Monte Carlo simulation. You run a lot of different iterations of your model with different assumptions, and then you get a range of economic outcomes. And what derivatives can do is they can really shrink that range. They can help provide certainty. So basically, you can use derivatives like forwards or like options to lock in an oil price. So then that eliminates your downside risk for an oil and gas project. You can use interest rate swaps to make sure that your interest rate is fixed rather than floating. So that reduces some exposure. Or you can use, FX if you're doing a project in a country that has a really unstable currency, like Argentina, for example. You can lock that rate in. And really, this helps provide certainty. So it does affect your cost of capital as well, potentially. But what it really does is bring up the downside risk. You don't have that risk that your project is going to totally fail and, not make any money at all. So that really helps provide, when you're sitting in the room with executives and they're like, well, this project looks good kind of on the 50% basis, but what about the downside? What's the value at risk here? How much could we lose? And derivatives really help to limit that risk. And therefore, these real economy projects can go ahead or not based on whether or not there's access to derivatives, whether or not you can limit some of that risk.
Jim, you might be muted.
Pardon me. In addition to Blair's answer, and as mentioned in the rapid fire round just now, banks also provide their energy consumer borrowers with commodity derivatives that provide for the actual delivery of physical oil and gas to the consumer client. So in this case, I think the real economy impact is very clear, as here banks are, again, literally using derivatives to fuel the industrial processes that directly lead to higher GHG emissions and thus the real economy impact. But there are other types of derivatives. Blair touched on a few of them, such as credit and equity derivatives, where banks allow investors to invest in and leverage positions in stocks and bonds that these investors don't actually own, but can synthetically own via a derivative. And many of these stocks and bonds having been issued by high emitting corporate issuers. So in these cases, derivatives effectively provide funding through the bank intermediary to these high emitting corporate issuers. And last but not least, we're going to touch on this a lot throughout this discussion, given how widespread the usage of these are. The most common type of derivative, interest rates, which again represents approximately 70% of the outstanding 200 trillion of derivatives in the US market. These are regularly used by banks to de-risk their corporate financing packages across all industries that banks lend to. So here too, derivatives at the very least are partially responsible for enabling financing to high emitters, thus establishing a clear link between real economy emissions and a bank's derivatives activity. Risha, back to you.
Thank you. That was super, super informative. And I just want to move on to the next page, like the mailbag question we have here. So this question basically asks whether and how climate risk is being reflected in the market value of assets. And the questioner asks why climate adjustment is needed for derivatives if the risk is already being priced into the underlying assets.
Yeah, I can take this one first. So the questioner is right that if climate risk was fully reflected in the credit risk of banks' counterparties, in the market values of assets, existing risk models would pick that up. You mentioned credit valuation adjustment models earlier, Richa. That's the main models that banks use for derivatives, and those would pick up climate risk if they were reflected in these underlying asset prices. But that is a huge if, and there is mountains of research from Ceres, from our partners at PRI, from the NGFS, from the Fed, that this is not happening. And so that the short answer to this question is climate risk is not priced in. And when that requires kind of back-end adjustments to these models that we wish we didn't have to do, frankly. We at Ceres really want to work towards a world where credit risk, counterparty risk, asset values reflect climate risk to the fullest extent. But we're not there today. In our 2020 report, we looked at this question and we found overwhelming evidence that climate risk is not being accounted for in asset values. We found in a 2019 survey that we found 93% of institutional investors agreed that climate risk was not being accurately priced into financial markets, 93%. So I don't know who the 7% were that thought it was, but it's pretty overwhelming. The NGFS I mentioned, this is a global organization of 121 central banks. So basically the folks tasked with global financial stability. And they agreed, it's hard to get 121 central banks to agree to anything, I think, but they agreed that there's a strong risk markets are not pricing climate effects correctly. And our central bank here in the United States, the Fed, has also found the same. The Richmond Fed did a really interesting study where they looked at different types of assets and how they reflected climate risk. And what they found is that there has been some progress, some assets that are completely obviously exposed to climate risk, like mortgages in flood zones. We saw the awful hurricane in Florida a few weeks ago. Those homes, the value of those mortgages is pricing climate risk. But anything that's kind of less obvious than, houses in the path of a hurricane, they didn't find the same effect. So even things like the share prices of food companies in drought-stricken regions like the US Southwest, those assets weren't reflecting climate risk, even though that seems almost as obvious as the mortgage piece. Our own work, Ceres work with banks, indicates that a lot of banks are still thinking about this as a reputational risk. They're pricing this as something that could affect their overall position in the market, whether consumers choose them, whether businesses choose them as a partner, but they're not reflecting it as a fundamental financial risk, like a credit risk, a market risk, a counterparty risk. And some banks are definitely starting to do that. They're starting to adjust their internal credit ratings, but even there, it's still being priced at a discount. I think the amount that this is factored in is less than almost all of the evidence would suggest it should be. So we're looking at a market failure, and that's why we have to make these back-end adjustments to models, to CVA in the case of derivatives, because all of the existing tools are assuming efficient markets, that markets price all of the available information. And that's what we all learned in school, in CFA, but it doesn't always work like that in the real world. So we think banks need to do this. Banks do make adjustments to their models kind of as a matter of course. It's not like this is some totally weird thing that's never been done before. Think about how banks' internal credit ratings get adjusted. For those of you who work at banks, how you take the Moody's or Fitch S&P ratings and adjust them to be your own internal credit ratings. You're doing this all the time. And so we're suggesting you do the same with derivatives.
Agreed. Probability of default and recovery both do not yet include climate related financial risk factors for sure.
This is super informative. And just want to take a step back here. And Jim, I want to ask you a question, something more related to disclosures. And I want to ask you, why it is important for banks to report on Scope 3. We talk about it so much. I want to hear from you why you think it is important.
Absolutely. So, and it's a great question. I'm glad that was in the mailbag. Yeah, the SEC is looking at a climate rule that may include Scope 3 disclosures. The ISSB is looking at including Scope 3 disclosures, CSRD in Europe, et cetera. So why is this important for banks? So here's a super interesting statistic. Okay. GHG emissions associated with bank lending, so again, Scope 3, can be more than 700 times higher than a financial institution's direct emissions. So again, Scopes 1 and 2. So from a bank carbon accounting standpoint, Scope 3 is where the action's at. Scope 3 is so important that for the financial sector, investors, regulators, and other stakeholders have actually given these emissions a specific name. They refer to them as financed emissions because it's the financing from banks that directly lead to the real economy emissions of the borrower. Now, Ceres has written 2 reports on the subject of financed emissions from bank lending activity with a few important conclusions that I'd like to just summarize quickly. The first report, which we released in 2020, found that more than 50% of US syndicated lending, which is around 500 billion, is exposed to climate-related transition risk. So transition risk being the economic and financial risks arising from changes to policy, regulation, and/or technology as society transitions to a net zero economy. The second report, released in 2021, found that the value at risk, or VAR, from physical risk factors in the loan book of the big US banks would lead to an additional 250 billion in exposure. So again, that's around 10% of the loan book's value. Now, the recent report that Blair and I wrote on derivatives discusses how bank provided derivatives are another major, and before our report, underexplored type of bank financed emission that contributes to real economy GHG emissions, as we discussed earlier. And the exposure of banks here is material. So for comparison purposes, the credit exposure from bank syndicated loan portfolios is approximately 2 trillion. And the credit exposure generated by derivatives for the top 25 largest US banks is an additional 50%, or another 1 trillion on top of that. So getting a better handle on all of your Scope 3 emissions is of critical importance for banks, both domestic and international. Risha, back to you.
I'm very glad to see, Jim, that you have come around to my 50% answer from earlier. I think maybe I won that round.
Points will be disclosed at the end, but yes, maybe you did.
But that's super helpful to note, Jim. This raises another question that I often get from a lot of people that I talk to. There's obviously so much confusion around what is financed emission versus what is facilitated emission, and specifically because we're talking about derivatives, like what category does derivatives belong to in that case?
Okay. So yes. So generally speaking, when investors and regulators, et cetera, talk about financed emissions, they're usually talking about the financing that financial institutions provide companies that then allow these borrowers to emit greenhouse gases. So traditionally, the financial institution activity that gets mentioned the most is lending, either through a loan or through investing in a bond. But what is the essence of why something is a financed emission? So we're very happy, Ceres is very happy to add to the body of knowledge developed by PCAF and others on this topic. Specifically, we put forth in our recent derivatives report that all financed emissions have the following things in common. The financial institution acts as a principal, they use their own capital, and the activity creates credit risk. Now, that's obviously true for loans, and derivatives as well fits this description. Now, we were talking about facilitated emissions. Banks also provide companies with other useful services, typically via the investment banking division, such as bond underwriting, equity underwriting, M&A advisory services, etc. Most market participants refer to the emissions arising from this type of banking activity as facilitated emissions, in that the bank is acting as a broker of sorts, bringing investors and issuers together, or issuers and issuers together in the case of M&A. However, unlike with the financed emissions and the definition I presented earlier, in this type of activity with facilitated emissions, the bank is acting as an agent, not as a principal. The bank does not use its own capital. And this activity, facilitated emissions activity, does not create credit risk for the bank. In fact, the value that the bank provides with facilitated emissions is really the provision of a highly skilled and unique professional service, in our view. Now, don't get me wrong, both types of emissions are important, or at least useful to measure and disclose. But as our report makes clear, in the hierarchy of priorities, we would suggest that banks focus on understanding their total financed emissions, again, including derivatives, first. Because as they have more relationship influence here, they can leverage these relationships to reduce their own climate risk, while also helping the borrower transition its business model to be more sustainable. So, win for the bank, win for the borrower, and of course, win for the systemic integrity of our financial system.
And
back to you, Richa.
And who wouldn't like that, right? But just on the question on measuring and disclosing, I want to ask both of you another question, I think very interesting that we got, and I'm also not afraid to say this, a lot of banks have mentioned this to us, and that it is a very, very difficult task. It's not easy to calculate these emissions. So what do you think? What are some ways, starting with you, Blair, like what do you think is the way we can do this?
Yeah, we took a poll at our recent banking event, and I think only 4% of respondents felt like this was going to be an easy task, adding derivatives to emissions accounting. And so it's definitely not. There are some hurdles to be overcome, not least the many different types of derivatives that are out there and that all have sort of unique characteristics. But there are a lot of existing metrics that banks are already calculating every day can help with this. So a lot of the really hard work has already been done. So we mentioned CVA a few times. Banks are also calculating other metrics. So way back at the beginning, when we talked about how we got to the 50% number, which I was right about, we used mark-to-market credit risk. And that's a statistic that is reported by banks. It's calculated, very frequently and reported to the OCC. So looking at the mark-to-market credit risk of derivatives sort of puts them on the same level as loans. And you can start to kind of compare the two apples to apples. And so this metric already exists. And, Jim might disagree here, but one important thing is that it sort of matches the metrics that are used to calculate financed emissions for loans. So when you think about PCAF, which is, a fantastic organization that has really, broken the path here in terms of calculating financed emissions, they look at, historical data to figure out financed emissions from loans. It's basically at December 31st of the past year, how many loans did you hold? What was the percentage of those loans that, percentage of total financing? How did those emissions get attributed to each bank, et cetera, et cetera. And so the thing about mark-to-market credit risk is it sort of does the same thing. It's a backward-looking measure of, what you had on your books at a particular date. And you can kind of say that this is very similar to how loans are already accounted for in the PCAF methodology. So definitely up for debate, but I would argue that metric, because it's reported to the regulator, it's very easy to understand, and it's on the same sort of basis as what's being used for loans, could be a really good way for the banks to get ahead on this derivatives question.
Yeah, it'll come to no surprise to anyone that we disagree slightly on this one. And so Blair and I go back and forth on this one. And while I admit, Blair, that historical mark-to-market has benefits, I think that the loan equivalent risk metric, which again is something that all banks use, obviously the name loan equivalent risk, each institution has a slightly different name for this, but it's a metric that can be used to aggregate derivatives exposure and loan exposure together. And again, all banks do use this. I think that the loan equivalent risk, or LER metric, is superior. And I'd recommend that most banks should ultimately go with this metric. So a few things for us to consider. Generally speaking, investors are using portfolio alignment metrics as a proxy for transition risk, which I think is better reflected by this forward-looking LER metric than by the backward-looking measure like historical mark-to-market. Also, since LER represents a worst-case mark-to-market exposure from a statistical basis, using LER is similar to reporting a loan's committed amount instead of what some use, which is the drawn amount. I know there's a debate, within the bank community, within PCAF, as to whether or not it should be loans should be measured committed or drawn. But again, the nice thing about LER is it is more of a committed amount. So unlike the drawn amount, which fluctuates and could temporarily be zero, you're using a static amount. And finally, using LER will enhance disclosure consistency, which is of course important to everyone. As a bank's reported and publicly disclosed finance emissions, again using LER, will only change due to increases or decreases in real economy banking activity. Your LER will only change if you put on more derivatives or take derivatives off, not simply due to changes in the mark-to-market or value of the derivatives portfolio. So again, with using historical mark-to-market, which swings around, driven by things like mark-to-market volatility, you may have more or less financed emissions from your derivatives portfolio due simply to swings in the market with no real change in what you're doing in the real economy. But in any event, whichever method you prefer, the good news that Blair mentioned at the top of the question is there are several ways a bank can accurately and simply measure the climate risk arising from its derivatives activity using existing, well understood metrics. Richard, back to you.
It's worth noting that you and I are not going to be the ultimate arbiters of this question. That should be PCAF. They're the standard in terms of this area, and we talked to them as we were developing the report, and would love to continue to talk to them as they and the banks that are on their steering committee begin to tackle this, because I think PCAF has really shown a very collaborative model that works really well, bringing banks to the table, bringing, the concerns of kind of all stakeholder groups, and really figuring out a methodology that works for everybody. And they've done an awesome job of that with lending. And I know capital markets is, on the table right now, as well as insurance. And, we hope derivatives comes next, but yeah, Jim, we'll have to get back together in a couple of years and see which way PCAF ultimately ended up going. Maybe we can bet a beer on it or something.
Absolutely. And of course, they're going to go with LER. So you can give me that beer anytime now. Risha, back to you.
I couldn't agree more with you, Blair, on the PCAF's role in this. And also thank you both for your perspectives on historical M2M and LER methodologies. I think that's really interesting to see both the perspectives here. And with that, I think we've gone through a lot of questions that we got on the risk management aspects of it, but we did get a lot of questions also on the benefits and opportunities side that are available to banks who better integrate climate into their derivative operations. So wanted to hear a little more thoughts on that. So Jim, do you want to start this time?
Absolutely. Thanks, Richa. So benefits and opportunities available to banks who better integrate climate into their derivatives operations. Okay, great mailbag question. And yes, it's very important that we also discuss the massive opportunity set that we believe can be unlocked by better integrating climate into a bank's existing derivative models and derivative decision-making infrastructure. So as Blair mentioned earlier, sustainable financings need to increase by 3 to 5 times over the next decade just to keep pace with our global climate objective. And banks are already starting to provide borrowers with sustainability-linked derivative transactions, for those of you who weren't aware, which generally contain covenants or KPIs that will reduce the cost of the hedging arrangement contingent on the counterparty accomplishing certain sustainability targets being met. So this is fantastic already. And actually, I believe it was Deutsche Bank that's credited with executing the first sustainability-linked FX options hedging transactions a few years back. But for usage of this type of innovative product to become widespread, and becoming widespread, thus driving larger financial returns for the banks, while also making a positive impact on reducing real economy GHG emissions, banks need to, among other things, be able to properly mark to market the sustainability component of such a transaction. And this is only possible by better integrating climate into your models, the bank's models. So the sustainability component, it shouldn't just be something that lives in the deal documentation or is mentioned by management during an ESG report presentation. On the contrary, these features have real value when properly measured. And like everyone from a bank will know, without the connection between the trade book P&L and the sustainability-linked product enhancement, these innovations won't really move a bank's ROE, return on equity, and thus won't be widely adopted. So to wrap up, banks that can quickly incorporate model improvements that better reflect the value of climate mitigation will be the first to see the enhanced returns and thus reap the gigantic sustainable finance rewards available in the derivatives market. And with proper models that integrate climate, you can drive both decarbonization and bank profit at the same time. Blair?
Yeah, Jim, I think your last point is really critical there, because everything you said is true, but we don't want this to be just something that sort of sits in the financial sector and sort of floats above the real economy. I think there is a risk if it's only about covenants in agreements and banks dealing with other banks that the real economy impact gets a little bit lost. And there's a question in the chat that I thought was really good about this concept of leakage, or what happens if banks stop financing certain types of products? Won't somebody with less ethics, fewer ethics, just pick that up? And that is a huge risk. And it goes back to what I was saying earlier about a supply side only approach to the transition is not going to work. You have to drive changes in demand, and which means you have to bring up bring down the cost, bring up the supply of renewable energy and alternatives that are transition compatible before you can really draw down some of these fossil fuel projects, because otherwise you're not going to get a just and equitable transition. And so going back to the original question of how derivatives can help capture this opportunity, one of the things we hear from banks is that there's not enough sustainable finance opportunity out there. They're looking for it. They have these targets, but they just can't find enough places to put their money, even though they want to. And derivatives can help solve this problem. I think particularly in developing countries, there are all of these projects, that's where the transition is going to succeed or fail. It's going to be in China, it's going to be in India, it's going to be in Indonesia, in Brazil. It's not going to succeed or fail based on what happens here in the US or where I'm from in Canada. And so the opportunity that banks have to drive sustainable finance is about getting into some of these markets where there aren't sophisticated derivatives players already. So the banking market for derivatives is extremely concentrated, as you mentioned, Jim, and there's only a few institutions that control a huge amount of this business. And so those institutions have power to really put this to work for sustainable finance projects. There might be projects in some of these countries that, wouldn't go ahead because of uncertainty in interest rates, uncertainty in FX. And if the global banks can kind of come in on top of local lenders who may not have the capacity to do a derivative and, provide some certainty to these renewable energy projects, we really can scale up sustainable finance fast. So for me, it's yes, adding covenants into agreements is important, but to me, it's about the real economy and particularly how you drive uptake in developing countries.
Yeah, and just to add to that, because I think Blair raises a very, very key point. In discussions that we've had over the last several months with banks related to derivatives, but also just related to more business as usual activity, the issue of how do I get these sustainable finance deals approved has come up. And again, much like we're discussing in this webinar about the need to adjust derivative models to factor in climate, we would also suggest that your other return models should similarly be adjusted as well. If your bank has a goal of increasing a new lending sector, if you want to increase sustainable financing, but you're using metrics that are business as usual metrics from a different era where you had different goals. So again, if you're using ROE or RORC or return on regulatory capital, return on risk capital, all these metrics that we all know and love, and you're hoping that those will support a different type of lending paradigm, i.e. to the sustainable sector, this is one of the roadblocks that we see for banks in terms of accessing this new type of business. So again, Blair and I hear all the time, we can find these deals, we just can't get them approved internally. And so somewhat tangential to the derivative report, but related to the comment on models, there's probably a need for an additional metric, an ROC type metric, a return on carbon, a return on climate type metric, in addition to your existing deal evaluation, client evaluation metrics, just to shed light on the fact that credit rating is not the only thing that should be driving your lending decisions. But if your bank does have a net zero target, if your bank does have a sustainability target for increasing lending to that sector, including a return on climate type metric, just to show the impact you're having on the real economy, is something that we would highly recommend. Yeah, thank you. Risha, back to you.
All right. So I'm seeing some questions come in since we have some more time. I think just want to go to Blair on this one. We talked a little bit about what benefits and opportunities bank will have, but can we take a few seconds here to talk about, actually a few minutes here to talk about what banks are actually already doing in this area? I know, Blair, you alluded to some of it in earlier, but would love to hear a little more on that from you.
Yeah, for sure. And it's an important point, is that this is really early stage. So I think, Jim and I come out here and, we act a little bit sometimes, I think, like this is all figured out, and it really isn't. The whole point of this report was to really start a conversation. I think, banks are rightly focused on lending. Lending is, the number one climate related thing that all banks need to address. And we're seeing a lot of movement on that front. We've seen the large banks make net zero commitments that apply to lending. We've seen smaller banks really start to figure out the risk management aspects of this and start to do client engagement, due diligence, et cetera. And that's all great. And we definitely wouldn't want this to distract or get in the way of this. So we actually think that, lending has been appropriately prioritized. Capital markets too has seen more action. But, to answer the question, not much has been done so far on derivatives. Jim mentioned there's a couple banks in Europe, Deutsche Bank, who's starting to think about this, but this is really the start of the conversation. And so, we don't have all the answers. We've taken some stabs in the dark, trying to figure out where we might kind of go from here. But, I don't want any of the bankers who are listening in to feel like they're way behind. You're not. Even the most sophisticated banks in the world are just starting to think about this. And so, if you are one of those banks, let us know, and we can help you start to think about this for sure. But it is really early stage. And I think we're going to probably come back and watch this webinar in 5 years and be like, what were we thinking? We did not predict how this derivatives climate space was going to evolve. I don't know, Jim, maybe you'll get everything right.
That's the hope. Jim, there's another question on credit default swaps. And somebody has asked how do you evaluate those for investments in climate sensitive locations like California, Florida, or Texas? Would you like to take that one?
Sure. Yeah. Very, very technical question. Very interesting question. Okay. So how do you evaluate credit default swaps for investments in California, Florida, or Texas? Okay. So here are a few thoughts. So this is a great question, and I'll do my best to answer it in the time remaining. But whoever asked it, I don't see a name, Risha, attached to the question. Feel free to email me directly, and we can find time to discuss in more detail. I'm at jscott@ceres.org. Anyone else who wants to email Blair or myself, please feel free to do so. Credit default swaps. So for those of you who haven't used them in a little while, these are tools that banks provide. They're derivatives. They're used to lay off or get access to credit risk, typically from a loan or a bond that you can't get access to in the cash market. For whatever reason, you can't buy that bond or buy that loan. You can use a credit default swap to get access or to hedge the risk using CDS, i.e. credit default swap. So going back to some of the points we touched on earlier, generally speaking, it appears that CDS spreads, credit default spreads, do not reflect climate risk for most issuers. So sovereign issuers like the state of California, Florida, or Texas, or the corporate issuers who are based in those states. So if they did, it is likely that PD, probability of default, would be higher, and recovery, post default recovery, would likely be lower. So stripping out any distortions related to market liquidity, general supply and demand dynamics, it's probably a cheap time to buy protection on these states. And conversely, for all the lenders out there lending into these states, you're likely not receiving enough premium for lending to these states. Just again, given that probability of default recovery does not factor in the climate relevant financial risks right now. And I could nerd out and talk about this for hours, but probably best if I hand it back to Risha at this point.
Thank you, Jim. And like you mentioned, anybody on this call is free to reach out to us directly to discuss any of the things that were discussed today. And we still have a couple of minutes, so we can take more questions. I see some of the questions that have come in through the Q&A feature of the Zoom as well. So let's take these questions first. So Nessa asks if there is a model stating how much banks should adjust probability of defaults to reflect climate risk. What are the factors taken into consideration? Blair, would you like to take that one?
Yeah, I can take this. And, ultimately every bank is going to have to do its own model in this respect. And it's going to be proprietary. The banks that do this the best are going to do better than the ones who don't. But for our report, this does get into sort of the meat of it, the analysis we did with our partners at ClimateFin. And the way their process works is they use climate scenarios to shock default probability. So Jim was just talking about, two of the critical metrics that we look at both for loans and then also for the underlying and derivatives: probability of default and then loss given default, how much you lose if there is a default. And so what ClimateFin does is they take a scenario where the economy suddenly shifts from business as usual today, climate risk not priced in, all of a sudden to a scenario where the transition is fully priced. So like, for example, the NGFS net zero scenario. We actually do it with 5 different scenarios in the report, but that's sort of the baseline one. And then what their model does is it says, in the event of this sudden equilibrium shift, the sudden shift from one scenario to another, what happens based on both an economic model and integrated assessment model that says what happens to oil price, what happens to oil demand, what happens to electricity demand, et cetera, and then a credit risk model, which is for individual sectors and companies. How do all of those impacts actually affect probability of default? That's how this amount is calculated. So this is the 7.3 billion that we mentioned in the rapid fire. The way that we got to that is by basically saying, if tomorrow market sentiment is 100%, we're doing the NGFS net zero scenario, and that all of a sudden overnight becomes fully priced in, what happens to these probabilities of default of counterparties on derivative transactions? So that's how the model that we use works. And that's probably how banks' models in general will have to work, although there will certainly be, scenario selection and individual credit risk modeling for particular companies or sectors will vary a lot. So I don't know if Jim, you want to add anything to that?
That is a complete answer. I wanted to just make sure we got to a couple more of the questions in the on the online chat, Risha.
Yes. So Francis asks, what comments do you have when banks push back with the drug dealer excuse? If you don't finance these sectors, somebody else with less ethics will. And also want to club this question with what we got on Slido on somebody asking how data would help investors assess the climate risks of banks' derivative activities. So Jim, over to you.
Yeah, absolutely. So this is a good question. Let me try and squeeze in an answer in the time remaining. So the kind of the question uses the colorful language of the drug dealer excuse. If we don't finance these sectors, someone will with less ethics will. So I don't think that there's a one size fits all answer for this type of thing, because again, let's not that I'm trying to equate our friends in the fossil fuel industry with drug dealers, but let's just suggest that, the fossil fuel industry. So when you take a look at the super majors who are, Exxon and some of these bigger folks, surprisingly enough, they don't get a lot of capital from the banks directly. They have standby facilities, which are typically undrawn. These companies are just making so much in retained earnings that's how they finance a lot of their capex. So and they also have high degrees of mobility. The number of banks globally that would like to lend to them probably exceeds the need they have for banks. So there, I think it's correct. I think that if every bank in country X just said, for climate reasons, we're not going to lend to the super majors anymore, they'd probably be able just to move elsewhere and get capital elsewhere. Now, in the United States, for example, some of the smaller, regional fracking companies in Pennsylvania, some of these folks, they probably can only get capital from a handful of banks, 2 or 3 different banks. So with them, if the banks decided to turn off the tap and not finance them, they probably would be unable to access financing, debt financing anywhere else. They couldn't go to the bond market, they're too small. The bank market, in this case, would be off limits to them. So they probably wouldn't be able to continue operations with all the various knock-on effects of that. So again, I think it really depends on the company you're talking about. Now, moving back to the subject of our report, derivatives, and specifically over-the-counter derivatives, which is what the subject of our report is. The good news there is that the large banks, like I mentioned, the top banks provide 95% of derivatives. And, most corporations want to transact derivatives with banks, especially OTC derivatives. So there, this leakage really does not exist. If a bank decided to stop providing derivatives to those corporations, they probably couldn't access those risk management facilities anywhere else. And so, as we mentioned earlier, this is why we're focused on banks and derivatives. This is one area, unlike lending, where banks have real relationship leverage on the financed emissions that they put out, which again are considerable when it comes to their derivatives portfolios. And I'll end right there because I see we have just 1 minute left. Richa, back to you.
Thank you so much, Jim and Blair. And on behalf of Ceres, I would like to thank everyone who joined the webinar today for your participation and for your interest and for please submitting some of the questions and all the other questions that we got while the webinar was on. And of course, thank you to the 2 of our panelists. Really, it's a pleasure to work with both of you and for this conversation today. Would like to remind everyone to please download the report if you haven't read it. It's available for free on ceres.org, and the link is also available in the chat. Just before we sign out, I wanted to mention our annual Ceres conference, which is going to be returning in March of 2023 in New York City. So please stay tuned for this, and you can visit our website to find more information on that, and would love to meet some of you in person there in New York. And just lastly, would appreciate any feedback on this webinar. So if you could scan the QR code here or access the link in the chat and let us know your thoughts on the webinar to make these events more important for you and informative for you. So thank you so much, everybody, and have a great rest of your day. Thank you so much for joining us.
Thank you,
Thanks,
everyone.
everyone.